Over the years, I've traded with tons of different indicators, strategies, and methods. And if I had to go back to the beginning of my journey and give myself the best advice on what strategy to learn, it's going to be the advice I'm going to give you all in this video. So if you're new to trading, or if you're struggling, or maybe you're flip-flopping around on strategies and methods like I was, then pay attention, as this video series is going to be the best 3 order flow tools and how you can use them in your trading so you can read the markets like institutions and not fall for the traps that they set for us retail traders. Now, the purpose of these videos is to introduce you to auction market theory and the order flow tools to use so that you can start confirming whether or not buyers or sellers have an agenda to move price in the direction of your trading setup. If you're new to my channel, I would recommend subscribing so that you don't miss the next lessons in this series. The first video will cover how the auction works, and then in the following videos in the coming weeks, we're going to go over footprint charts, Bookmap, and the DOM, or depth of market. It's going to be good. You don't want to miss it. So before we go into these tools, you need to understand the basics of how the auction works in the market. So let's go overhead to my PowerPoint, and we're going to get into auction market theory. Alright, so first lesson in the series of order flow is going to be auction market theory. Now, if you haven't heard of this before, it is a philosophy where financial markets move higher and lower due to imbalances between buyer and seller aggression, which is caused by market events, until price discovers a level where aggression is balanced and the most trade can be facilitated. All auction market theory is looking at the buying and selling to determine who is in control, whether there's a balance in price or an imbalance in price. So let's look at a typical sort of market graph between buyers and sellers, market demand. And we're going to kind of relate this to the stock market. But first, we're going to understand how an auction works, right? How the auction works. So let's say we'll look at houses, for example, since everyone knows houses. You have a house that's $400,000 and the market is pricing it around $400,000 and it's moving around this area. Now suddenly a market imbalance happens where demand exceeds supply. All right, you can think of COVID, right? The COVID crash after that, 2020, 2021, what happened with prices, right? Everything moved up. There was an imbalance caused by a market event, and now prices are trading up here at 450. So they were fair value at 400,000. The market event happened, and now buyers are willing to pay more, 405, 410, 450, 420. And we get up to 450, and the market starts moving around up here at 450. Now, this is fair value, and this is a balanced range where buyers and sellers are trying to determine what the fair value is and how much they want to pay. A key thing to understand is that the market will move up until the last buyer buys, and the market will move down until the last seller sells. What does that mean? Let's say there's let's say you have a neighborhood, and every house in the neighborhood is about $450,000, and then you want to sell your house for $460,000. You are a limit seller. You are a passive seller at this point, where you don't want to aggressively sell your house. You can sell it for $450 right now. There's a buyer that'll pay $450, and they'll transfer the funds right now. But you don't want to. You want to sell your house for $460. In order for your house to be sold, there needs to be a buyer willing to come up here and buy your house for $460,000. And so let's say there's sales for $456, $457, $458, $459. All right, let's say a buyer buys a house at $459. If there's no more buyers that are willing to pay $460,000, then no houses will be sold, and the market will have to move down to facilitate lower prices to attract new buyers. All right, if you're selling at $460 and there's no one willing to buy, if the last buyer bought at $459, you won't sell unless it's $460. The last buyer has bought, and in order for trade to be facilitated, the market will have to move down to attract new buyers to lower prices, and then you would have to come down to $450. And then you would, in the stock market, it just moves down and it establishes a new fair value. You have a market imbalance, the sell side, right? Let's say the supply exceeds demand. No buyers want to pay $450. COVID is overvalued. They want to pay down in $420. Then the market will move down and facilitate trade down here at a lower price. The buyers and sellers will try and establish fair value, and then from this point, they'll either move up or they'll either move back down. And in the stock market, you have this dance between price where it moves up and down, sideways, and back up, sideways, maybe up again, sideways, back down, sideways, and the participants are always trying to establish where fair value is. All right, that's the basics of how the auction works. Now in the stock cycle, we see this thing where we're just talking about, you have a consolidation period, breaks a high, and then it starts to accumulate, and then we distribute, and then we come back down to capitulation, and then we start over again and we consolidate. And this is sort of the overall stock cycle of how stocks move and how the auction place moves. This is just an example I pulled up. This is Elf Beauty. This is a weekly chart, and we see the accumulation, we see the move up, we see a consolidation point, we see accumulation, we see a move up, right? This is the imbalance in price. And then we get to this consolidation period up here where buyers and sellers are trying to establish fair value. Once it got up here to 221, there were no more buyers willing to buy up here at 221. That was too overvalued, and so price had to move down to attract new buyers down here. It consolidated, it came back up. You can call this a double top. Essentially, right up in this area, buyers still were not willing to pay more than 220. The last buyer bought, and the market had moved down to facilitate trade as the sellers took over control. And it came right back down into this area, and we start to see it consolidate again. This sort of movement is very clear on this chart. Now the participants are consolidating, and they're attempting to establish fair value to see if this is going to go up or if this is going to go back down. And then square is another great example on the monthly chart. You have the consolidation, you have the accumulation move up, you have this distribution, and then you have capitulation in a big way. And now it's gone sideways again. Buyers and sellers are attempting to establish fair value and see if we're going to get prices that are going to move up or back down. And that's the stock cycle and the basics of the auction. Now let's apply it to trading. You must understand the terminology and concepts of order flow in order to start making trading decisions. These next few slides will break down the terms used in order flow analysis. All right, so order flow is a loose or a fluid term that can mean multiple things. All right, you got to think of it like a wave, like it's the flow of the markets, the flow of the orders. It's not this concrete thing of support and resistance. All right, buying can look like selling, selling can look like buying. We're going to unpack that. If 100 lots hits the bid, aggressive sells, does that mean that we should become a seller? No. All right, there's two sides to this coin. For every buyer, there is a seller. For every seller, there is a buyer. If you are buying, you're buying it from someone that is selling it to you. If you are selling something, you're selling it to a willing buyer. So although the participants might be aggressive and selling aggressively, there could be willing buyers ready to absorb those orders and move price up. So selling does not always mean this. It's not this binary thing where if you see sells, you sell, and if you see buys, you buy. It's not as simple as that, and we must use the flow and creatively understand the relationship between buyers and sellers and price. All right, a key word is creatively. As we go through this order flow series, is coming up with a creative understanding, things that are not obvious. If everyone can see it, it's the least likely to happen. All right, so buyers and sellers. Some of this may be review for some of you, and that's fine. And even if it is, you should watch it, because repetition is how you learn things. So if you've heard it before, listen to it again, and if you haven't, you're probably gonna need to hear it a few times. All right, there's a buyer and a seller for every transaction. There will always be a passive limit order and an aggressive market order participant for each transaction. Passive is patient. There's no urgency. All right, that means that you're in. We'll use Bitcoin. You're in Bitcoin at 50,000, and you put a limit sell at 100,000, and you don't care how long it takes, but you're going to leave your order there until it gets filled. You're a passive participant, and you're a patient limit order. An aggressive is a market order which wants to be in right now, and there's strong urgency. In that situation, let's say Bitcoin hits 100K, and right when it hits 100K, there is an aggressive participant that wants to buy 100K. Someone wants to buy Bitcoin at 100,000. They think it's going to break out and keep going, and they want to be in right now. Then they would market buy in, and that would get filled by your limit order. Their market order would hit your limit order and fill. Passive orders are filled by aggressive orders, the market order getting filled by a limit. All right, a limit can't fill another limit, and a market can't fill another market order. So this gives us an understanding between the patient participant and the aggressive participant. When you're patiently selling, there is someone aggressively buying on the other end. And that's where creative context comes in, because again, You may be in Bitcoin at 50K and you're ready to get out at 100 because you're up 100%, and there is other people on the other side that think that Bitcoin is going to break out and move up higher fast, so they get in. So if you're selling to a willing buyer, and if you're buying from a willing seller. All right, limit order versus market order. So as we were talking about, a limit order is passive. This adds liquidity to the market, and it's filled by a market order. All right, the level 2 is limit orders. Orders waiting to be filled by the market, and they're constantly moving on the book. All right, a limit buy is a passive order waiting on the bid. A limit sell is a passive order waiting on the ask. All right, you are asking your 100,000 for your Bitcoin, and then your bid is you are buying Bitcoin at 40,000. I don't want to buy Bitcoin unless it's 40,000, and I'm going to put my buy there, and I'm going to wait until it gets filled. A market order is aggressive. It's an urgent entry, and you're willing to pay any price, and it's filled by a limit order. All right, so if you are a market buy, this is where things get different. If you are a market buy, you are an aggressive order hitting the ask. All right, so the person waiting there at 100,000 Bitcoin, their limit sell, you are market buying from that limit order and filling that limit order, and that transaction is now complete. If you are a market sell, you're an aggressive order hitting the bid. The passive buyer waiting there, waiting to buy Bitcoin at 40,000, when you come down and you market sell at 40 because you think price is going to go lower, you aggressively sell to the bid, and you are selling to that buyer at 40,000. And so this is going to be a DOM, and we're going to go over this in one of the future order flow series videos. We're going to unpack this in its entirety, but I just want to unpack it so you can understand how the book looks with bid and sells. So here's your price, here's the ask, which is this red column, and then you have the bid, which is the blue column, all right? And then this at bid and at ask, these are the market buys and sells, all right? Red is sell, blue is buy. So here's 60-32 on ES, all right? If you are a limit buyer at 32, that means there's 88 passive buyers waiting to buy at 32. Up here at the sell, 36, there's 369 passive sellers willing to sell at 636. This could be someone who's already in a trade and wants to exit at 36, and they put a limit sell there, or it can be someone that's not in that just wants to get in and sell short. All right, in order for these orders to be filled, in order for 369 to get filled, we would need price to move, and we're going to look at this column right here. This is the recent trades at bid and at ask. So let's just say, for example, there was 62 limit buys in this column. What this red column is indicating is that 62 participants aggressively sold on the market and got filled by these limit buyers. It's a passive order waiting on the bid, and limit sell is a passive order waiting on the ask. All right, so this limit buy right here, this bid, was filled by this aggressive sell order. So this bid at 62 was filled by an aggressive market sell order, which is this 62 number right here. I mean, 62 people, market sold, and then this got filled. And then conversely right here, this means that 99 market buyers hit and filled the limit order. There's one right here, and this is constantly changing throughout the day. Now, how you can use this, we're going to unpack this later on in the DOM, but how you can do it is, and it happens quick, but if you're looking at the book, like this 99, for example, this says 24 and this says 71. I see 99. If we move up and then I see 100 here, and maybe I see small numbers, this tells me that there's aggressive market participants, aggressive buyers coming in, and they're clearing out the book on the sells. So if the aggressive buyers are, if you see these big numbers that are overpowering all these numbers, like 100 comes in, then 150, then 120, then 90, and then maybe 200 comes in right here, I know that the aggressive buyers are strong and they're locking out these sellers. Conversely, it's the same thing down here. 62 comes in, 24. If I see large sell orders coming in and it's clearing out the book, that gives me a view into the aggressive participants and their relationship with how they're affecting the bid and the ask. But that's just a preview on the depth of market. This is a price ladder. The reason I have it in this first slide is because I want you to understand the limit in the market buy orders. And I also want to highlight that if you type in like trading floor, like stock market, Wall Street trading floor, you're going to see this. You're going to see a price ladder. The professional traders, the institutions, they're looking at a price ladder the bid and the ask and the recent trades, they're not even necessarily looking at candlestick charts. In fact, there are some firms and some traders who only use a price ladder and don't look at candlestick charts. Now, depending on how long you've been trading, I want you to wrap your head around. Imagine getting in front of your computer screen and trying to make money trading without looking at a candlestick chart. It might sound kind of like, I can't imagine doing that. We're all so married to the candlestick chart because everyone learns on that. But the professionals are using a price ladder, and some of them, the really good ones, they don't even look at candlestick charts, and they're just scalping off of the actual orders on the book. Your trend line and your support didn't break or didn't resist because of your trend line. It's because the buyers and sellers were too aggressive, and they were absorbing all the limit sellers, and the buyers pushed price up, and the sellers were not strong enough to resist the aggressive participants in one direction. This is what's going on behind the scenes, behind the candlestick chart. So keep that in mind as we go through the series. This is something that you are definitely, if you don't have this in your trading, if you want to take trading seriously, you're going to need to have it added in at some point. Now the next lesson we're going to go over is going to be footprint charts. It's going to be a really good lesson. This is my main order flow tool I use to help confirm my entries and exits. All right, now that you have a better understanding of how the auction works, make sure to subscribe so that you can be notified when the next videos in this series drops. In the next video, I'm going to go over footprint charts and why they are the single best order flow tool to use to find trade setups. I'll see you in the next one.